Okay, Greg, we've talked about, a lot of different mortgage products.
Mhm.
How does it work if somebody is self-employed? How does that change employment verification and the whole mortgage loan process?
Great question. So, self-employed borrowers are way different than our hourly wage earners. So, with an hourly wage earner, I can easily calculate on paper what they will make based on the number of hours they work, and I can do that for an entire year and get their income very simply and easily. For self-employed borrowers, well, we know that when we file our tax returns, that we expense. There's always expenses. We expense items for the job requirements or for this, that, and the other thing. We always have expenses when we're self-employed. And so what happens in the mortgage industry is typically for a traditional conforming loan, um, we look at, okay, this is how much you made, but what did you expense? And it's what you made minus what you expensed. That's your typical net earnings. So we use net earnings typically as the number of what you actually make. Now, for our self-employed borrowers, you're probably saying, "Well, that's not really what I make," and we get that. But there are other creative solutions and tools we can use, mortgage products, to help you still qualify. For instance, let's do an example. I am a self-employed borrower, and I made 100,000 in revenue, but I wrote off 50,000 in expenses.
Yeah.
A normal, typical loan product would require us to use probably around 50,000 as your income. Now, there's some things that we can do that are called add backs that we can add back in to increase your income a little bit, but it's going to be around that 50K number. So that's normal, traditional financing is how they look at it and perceive that. But there's a different product, and it's called a bank statement loan. And so a bank statement loan says, give me your last 12 months of bank statements, either individual or business bank statements. So we can do either. Okay. And I'm going to add up all your deposits for the last 12 months. And that's your income. We don't look at expenses at all with a bank statement loan. Now, this loan product requires a larger down payment. Typically, 10% is the minimum down payment with that. Now, if you're, trying to go the traditional route, you could get a down payment as low as 3%. But if you're struggling to qualify, you make good money, you have money saved up, we can still get you a loan with a bank statement loan, 10% down. So that is kind of the differences between the two products, but then also how mortgage lenders perceive and look at self-employed income.
Okay, awesome. Thank you.
Yeah.